have Gautam Baid from Complete Circle Stellar Wealth PMS joining us on the show now. Gautam, started the new fiscal year. It's been a good start. We have a lot of tailwinds also in front of us. You know, the elections where political stability is likely to continue. India's macro looks fairly resilient. But it's just that after the kind of year we've had, last 2 years, it's all about picking individual stocks. So how do you navigate through this volatility and your view on the market?
Sure. So first of all, good morning, Surabhi and Reema. Pleasure to be back on your show. You're absolutely right that the valuations in the broader market, especially for the quality names, is still pretty expensive. Early in March, there was a short-term sell-off, which led to the hope that maybe we could get more reasonable prices. But quality names tend to get bid up very fast after every correction. And that is exactly what we saw in the last few weeks. The quality stocks are the ones which have bounced back the fastest. And I believe from here on, the markets will become more narrow. And the focus will shift to those stocks with strong earnings growth visibility and which are enjoying sectoral tailwinds, because they are the ones which will find buying favor after every correction going forward. So one needs to be very selective and have a bottom-up approach, not go down the quality curve and not compromise on valuations. I think if you pay attention to quality and valuations and growth, this holy trinity, then you can do pretty well over the next few years.
Okay, so you have to be focused, stock specific, and ensure you stick to quality. Got that, Gautam. Great to have you on the show as always. Since you're telling us to be focused and specific, we really want to discuss two of the themes that you're tracking. Starting first with the BSE. Now, before I ask you the question, I must put the rally in context on BSE. So, guys, can we just pull up a one-year chart? I mean, this is a stock that has gone places and how. The one-year gain on BSE is already 533%. Let's get that one-year chart going on BSE, the Bombay Stock Exchange. There you go. What a move on this stock. It's not alone. A lot of the other plays around the capital markets, infrastructure sort of stocks, which are exchanges, whether it's MCX or brokers like an Angel One, etc. They've all moved higher. BSE has been absolutely phenomenal. So, Gautam, the question, what do you still like about this story, and does it still have the momentum to keep rising despite this huge move?
Well, so in our view, BSE Limited is one of the best operating leverage plays in the listed space in India, and there is significant scope for margin improvement as the business gains scale, because a large part of BSE's business is largely fixed cost based. So firstly, BSE has made considerable progress on the Sensex 30 index option contract, while BankX is seeing healthy traction on the expiry days. The management's focus now is to bring non-expiry volumes and to introduce long-dated contracts beyond the current expiry. And it also plans to gradually increase the tariffs on Sensex and BankX contracts beyond the current week, and that is going to be the big operating leverage catalyst for BSE. Secondly, BSE as of today enjoys a 5% market share in the index option premiums in India, and for now the management is more focused on growing its market share by getting more brokers fully enabled on BSE's platform. And once fully enabled, the company expects its market share to grow further. In most cases, BSE charges much more lower than NSE, as high as 40% lower in certain cases. And that's why in some cases, the business is not profitable right now. But the management wants to rationalize and improve these charges, these broker charges going forward as the business grows and gains scale. Currently, BSE is trading at a one-year forward P multiple of 40x on FY25 basis. And given the strong earnings potential over the next few years, driven by operating leverage, we expect these premium valuations to sustain. However, I would like to highlight the two key risks with BSE's business. Number one, any significant regulatory clampdown on the derivative segment can be a headwind. And second, any slowdown in the equity market participation can also be a headwind for BSE, because at the end of the day, its fortunes are linked to the capital markets. We own this stock in Complete Circle Stellar Wealth PMS as well as Stellar Wealth Partner India Fund portfolios.
What was the price at which you entered BSE in your portfolio? Because just looking,
it was very decent, Reema. We bought it around 2,300.
Okay, and what's the upside that you see? It's already at 2,800. The stock has corrected in the recent past, but do you have a fair value in mind at which point you will reassess your holding in BSE?
very difficult to assess the exact fair valuation for a non-linear business like this, Reema, because it's just like we discussed previously for multi-commodity exchange MCX, the earnings growth can be very non-linear in such cases because in such high fixed cost businesses, and that's why the key in such stocks is to just stay invested throughout the high growth phase of the company, because in such businesses they start off from cheap valuation, then they go to reasonable valuation, then they go to expensive, then very expensive, and then they ultimately enter a blowout phase. But we are still some way away from that. I think right now the valuations seem reasonable at 40 times 1 year forward. And if you look at the most recent brokerage reports on this company, they are expecting EPS CAGR over the next 3 years of more than 50% for BSE in the absence of any regulatory clampdown. That's a very important point, because we have seen in the recent past that the regulator is trying to just reduce the exuberance in the futures and options segment. So we'll cross the bridge when we come to it, but for now the prospects look pretty strong for BSE.
Okay, there is one more stock that you're recommending, which I think you hold in your PMS also, Equitas Small Finance Bank. Tell us more about it. Why now?
So Reema, I think the recent stock price underperformance of Equitas Small Finance Bank is presenting an opportunity for long-term investors, because this stock at the current price offers earnings growth visibility as well as potential for valuation re-rating. The credit to deposit ratio for Equitas Small Finance Bank, this is a ratio which many analysts track in the banking industry, especially in the recent past. The credit to deposit ratio for Equitas Small Finance Bank is expected to moderate with deposits picking up, and deposit mobilization has been pretty robust for Equitas in the last few months, primarily driven by the rise of retail term deposit products of 444 days and 888 days. That is where the bank is offering very attractive interest rates to depositors, and that's why the CASA ratio is improving for Equitas Small Finance Bank. If you speak about valuations, currently Equitas Small Finance Bank is trading at a price to book on FY26 basis of 1.4 times, and we believe these valuations are very attractive because of four primary reasons. Number one, over the next 3 years, the expected growth rate in the loan book and the earnings for this company is expected around 23 to 25%. This is the management guidance. Secondly, Equitas Small Finance Bank is going to be a significant beneficiary of the upcoming rate cut cycle, because 82% of Equitas Small Finance Bank's loan book is at a fixed rate, and that will ensure a quick recovery in its net interest margins when the rates soften. So that may lead to further re-rating of the company. Third factor which can drive re-rating for Equitas is ROA, return on asset delivery of 2%, with room for further ROA expansion over the next few years, driven by a steady cost to income ratio, improving net interest margins, and benign credit costs. So that may also, and we have seen in the private banking space in India that banks with an ROA of 2% or more generally trade at a price to book of 2.5 to 3 times. So there is sufficient room and valuation comfort here at the current price. Finally, what can lead to re-rating of Equitas Small Finance Bank in our view is the well-diversified loan book. 81.5% of Equitas loan portfolio is in non-MFI. So 81.5% of the loan book is secured in nature. And Equitas Small Finance Bank also has a better CASA ratio compared to most of its peers. The CASA ratio stood at 32.7% at the end of Q3. And that also gives us comfort that going forward, as investors look at the broad metrics of this company, we may see some valuation re-rating. The key risks for this company, though, are intensifying competition for deposits, which can put pressure on net interest margins. And the second risk factor for Equitas Small Finance Bank is worsening asset quality and its MFI book.
Okay, fair enough. So that's the upside.
Disclosure, we own this stock in our India Fund and PMS.
Got it. So you own the stock. You've laid out a couple of the reasons why you're quite optimistic on it. That's an interesting point about the large chunk of their book being fixed. So when we get into this downward rate trajectory, this is not a company that will be as impacted as perhaps some of the others. So interesting one. Gautam, stay on, because we're on the subject of financials. We want a broader view, with you as well on overall beyond Equitas. And let's start with what other than today's big newsmaker, HDFC Bank. We've got Abhishek joining in. So Abhishek, tell us, how do those deposit mobilization numbers look? Because that's what it's all about, right? The fight, the chase for deposits.
Well, in a tight liquidity scenario, they have been able to grow their deposit base very strong on a sequential basis. The deposits are up 7.5% quarter on quarter. In incremental wise, it's up 1.66 lakh crore in a tight liquidity scenario when it was up 1.5 lakh crore when the liquidity was good in Q4 of FY23. Even on a sequential basis, the incremental deposit growth is 4 times of what incremental deposit flow they saw in Q3 FY24. CASA ratio has actually improved on a sequential basis. We have seen CASA being a tough spot for many bankers, but HDFC Bank has been able to improve its CASA ratio by about 45 to 50 basis points despite strong deposit growth. Retail deposits are up 6.9% sequentially. Advances growth are on weaker side at 1.6% sequentially. Domestic retail advances have grown by 3.7% sequentially. Commercial and rural banking have grown by 4.2% quarter on quarter. Now, other wholesale loans that have declined by 2.2% on a sequential basis, and that's impacted the overall advances growth this time around. CD ratio that's dipped sharply to 105.4% when compared to 111.5% in the previous quarter. Back to you.
But I guess, Abhishek, that's along, expected lines. I mean, I'm guessing this is a strategic move because in any case, I guess it's become more about shoring up deposits. Perhaps, bigger banks feel that loan growth will take care of itself. But, Abhishek, what about the others? We've got updates from a whole lot of other lenders, right? What stands out for you?
Well, 3 of them that stand out. If you take a look at the AU Small Finance Bank business momentum, it's been pretty strong and it continued even in like last quarter. So deposits are up 25.7% YOY and about 8.8% quarter on quarter. Now, CASA ratio continues to decline. It's now down to 33% when compared to 33.9% in the previous quarter. It's an industry trend. AUM growth is pretty strong at more than 28% YOY and close to 8% quarter on quarter. Cost of funds that continues to inch up, and it's now at 6.98% versus 6.9% in the previous quarter, but the incremental pace has actually started to reduce for them. Surabhi Small Finance Bank, robust business momentum actually continues over there. Deposits are up nearly 20% quarter on quarter. CASA ratios actually improved sharply to 20.14% when compared to 18.5% in the previous quarter. In absolute value, CASA deposits are up more than 30.5% quarter on quarter. Disbursements are strong, growing at 38.6% YOY and about 30.6% sequentially. AUM growth is robust at 41.5% YOY and close to about 13.8% quarter on quarter. Their asset quality has also seen a marginal improvement with gross NPA ratio being down by 10 basis points quarter on quarter. RBL Bank now again the deposit growth over there is pretty solid over there. So deposits have grown by 21.9% YOY, which is one of the highest that you are seeing in last 3 years. Sequential deposit growth is about 11.55%, which is the highest that you are seeing in last 5 years on a sequential basis. CASA ratio that's improved sequentially. That's a heartening point to see. 35.2% CASA ratio in Q4 versus 33.8% in the previous quarter. Loan growth 19.2% YOY is the lowest that you are seeing in last 3 quarters, and it's up about 4.6% quarter on quarter. Their CD ratio now that's declined sharply by 550 basis points on a sequential basis. There could be some pressure on the net interest margin, but we'll wait for the results to come out. Back to you.
Okay, thank you very much for that. Gautam, are you surprised by the aggressive deposit mobilization that we've seen across from the ones which have reported their quarterly updates, HDFC Bank and even the others, as Abhishek was pointing out? Has that taken you a bit by surprise? Do you think this could be an industry trend? And therefore, is there a risk to margins?
Well, Reema, you're absolutely right that this intensifying competition for deposits can lead to NIM compression. But over the last few months, we have been seeing a lot of banks giving very attractive rates to the depositors to attract these deposits because of the RBI mandate to bring the credit to deposit ratio down. But I think, leaving this part aside, I would also like to add one important point here that, in the investing field, I think we should focus on those areas where there is decreasing competition. Right now, in the banking sector, you are seeing a lot of increasing competition for deposits, but there are certain areas within financials where the competition is actually reducing. I saw the ticker of Muthoot Finance flashing on your screen a short while ago, and in that particular industry, because of the RBI's recent actions against IIFL Finance for its gold loan portfolio, the competitive intensity is greatly reducing in that particular industry, and therefore the leader of the organized pack, that is Muthoot Finance, may benefit the most. And it's a leverage play on increasing gold prices. And right, just early today, gold prices crossed $2,300 an ounce. So I think that looks like a very interesting play, and the valuations are very reasonable. So that should be definitely researched a bit.
Okay, just one quick word. Avenue Supermarts, right? This was a sleeper stock. But, in the last 1 month, some brokerage upgrades started coming through. ICICI Securities, CLSA initiated coverage. And then this quarter's, quarterly update looks quite good. Is Avenue Supermart a part of your PMS, or is it, are you looking at it actively right now, given the underperformance, and therefore maybe its time has come?
Well, Reema, in spite of the recent underperformance, the valuations are still very nosebleed in our view. It's extremely expensive, and we do not have coverage on Avenue Supermarts in either our India Fund or our PMS. And in our PMS and India Fund, we look for companies which are growing much more faster on a secular basis. And unfortunately, Avenue Supermarts does not fit our criteria there. So neither the growth criteria, neither the valuation criteria, neither of the criteria are being met here.
Okay, so that's Avenue. Gautam, before we let you go, I just have a broader question, observing what's been going on with discretionary consumption, right? This was a week where we got to know that the Aditya Birla Group is now splitting their fashion and apparel business as well. I mean, Aditya Birla Fashion and Retail is getting split down the middle, and we know what Trend has done. So, A, do you have any interest in this space, which is discretionary urban consumer? Maybe through apparel, maybe through any other format of consumption. And B, if you do, then what's the sense? I mean, how should we look at, perhaps playing this? Gautam? Yeah.
Yes, Surabhi. I missed the last part of the question, but yes, we do have exposure to Cello World, as discussed in our previous interaction. As our exposure to discretionary consumption. It's a leader in opalware, glassware, and consumerware, and that is where we have exposure. And in most of the other consumer discretionary stocks, the growth rates are not really that appealing for us right now to take exposure, but we're monitoring this space pretty closely, because this is the time when the sector is undergoing a bit of a short-term headwind and a bit of a slowdown, that you can buy into good quality franchises at reasonable prices. So we are actively monitoring this space.
Okay, all right, Gautam. Good chat with you as always. Thank you very much for joining in. We look forward to the next one. You have a good rest of the day. Thank you.
Thank you.
All right, well, with that, we do have to take a quick break.